Exiting can mean different things to different people. Some may mean it's not maximizing for price. It may be just getting it in the hands of an employee or a member of the family to continue the legacy. So it's an exit. The other is sometimes it involves asset purchase. So this could be a packaging things up for one particular buyer or piecemealing them off. And you still have to kind of deal with the entity, whether it's an LLC or something like that. But selling the assets is another exit approach. And in some cases, winding down the business in closing, still an exit. And then there is what most people refer to, which is finding a buyer and selling it to them.
Climbing up, there's a struggle, tension in the air. But the underdog prevails, we here to declare. To the top or the mountain where champions stand. Failures can't break us, we taking command. Yeah, it's a journey, climb to the peak. Scaling businesses, who it ain't for the weak. Growth is the game, we play it real tall. From the bottom to the summit, we rise, never fall. Interview the legends, success stories told. Risepreneurs, hearts made of gold. Strategies unfold, in the struggle grace. Hardship and challenges, yeah, we still embrace.
Welcome back, everyone, to another episode of the Risepreneur Podcast, a show dedicated to all the entrepreneurs and business owners who's looking to grow, scale their businesses to ultimately exit at the highest valuation. Speaking of exit, today's guest would be very relevant and needed. I advise everybody take out some pen and paper and take some notes down. His name is Eric Grafstrom. He is the CEO, co-founder of the ExitGuide, a dashboard that we're going to talk about today. Prior to that, Eric spent a couple of decades in Silicon Valley working with various companies, major companies like Yahoo and so on, taking different roles, wearing different hats as business development, VP of business development, CEO, CEOs. So Eric, say hi.
Hello. Great to be here. Thanks for having me on your show.
Yes, Eric, before we dive in, it would be always good to... My intro doesn't do the justice, right? It would be always good for you to maybe properly introduce yourself, talk about a little bit about your experience and why listeners should listen carefully to when you speak.
I hope that's true. I like to think that a podcast is an opportunity to share a little bit of wisdom. So I started my career, back in the mid-90s. I joined a company that later turned into broadcast.com. So those of you that follow basketball or Shark Tank know of Mark Cuban. I was one of the first people they hired. And, we were acquired by Yahoo, and that took us over to London and then eventually into Silicon Valley. I left Yahoo before things really kind of got challenging for the company. Still very loyal and fantastic company, big fan of Yahoo, but moved back into early stage venture-backed companies. And so I, moved from sales roles to business development and into operating roles and did a couple turns as a CEO and COO. In the last few years before we moved to Austin, Texas in late 2020, the last few years, I was largely working on behalf of investors to help assess and in some cases turn around companies or help them exit. And the venture-backed model generally is this kind of very hits-driven. It's got to break out. And when they hit rough waters, they tend to have a list of people like myself that they would bring in and say, okay, what are we going to do here? Should we shut it down? Should we sell the assets? Should we, keep going and invest more money? And I learned quite a bit about the exit mechanics. And not everyone is this big ticker tape and you're standing on a stage and high-fiving. I mean, some of them are selling assets and other things. And I decided to take that skill set and turn it to Main Street. And the reason for Main Street is it's a huge part of our economy and it's really underserved. And so what I wanted to do is kind of take this knowledge that I had of helping technology companies, which oftentimes had significant resources, even if they were in trouble, and turn that to help really the small Main Street entrepreneur. So service-based businesses, retail, things of that nature, really get prepared for what is effectively the most important transaction of their career.
Awesome. And what made you make that shift, right? Because climbing corporate ladder, working in corporate environment, shifting to founding something of your own and taking the role of the business owner yourself. What made you shift?
One of the things I learned for probably my last year at Yahoo, I'm not cut off for big companies. Part of the reason that I left was as much as I love the company, I had a job that I probably would have been impressed with 5 years prior to taking it, but it was just moving at a different pace than I, really, was used to. So a lot of responsibility, but I felt like things were just, restrictive for me. And it's a very, this is all individual. So I'm not saying corporate jobs are not good. I'm just saying that you kind of have to learn what's within your own makeup. And so spending a lot of time with early stage companies is this ability to create things, move quickly. You're able to have a lot of influence. There's pros and cons of that because things don't work out and all sorts of challenges are from that. But I was, what led me to start ExitGuide was at the time I was consulting. I was a fractional exec oftentimes for a couple different startups and learning about baby boomers who were retiring and struggling as to what to do with their business. I just thought it was odd. Why would you struggle as to what to do with their business? And we'll get into this as the conversation progresses. But what I set on was most business owners aren't looking for help finding a buyer. That is true that many are, but even if they found a buyer, they still don't know what to do. And oftentimes, because they don't know what to do, they fail in actually getting a deal done. So 80% of businesses that go to market, in the small business arena, fail to exit. And so our goal is to actually help reduce that number, help more owners actually successfully exit.
Awesome. And we'll come to that. You made me remember my old days when I was in the corporate world dealing with things there. I do remember the restrictive environment where when I started my career as a web developer, I wanted to know what's in a database implementation world. They said, stay in your lane. Your focus is HTML. That's where you are. Just don't move anywhere else, right? And another one where we worked with pods as a client. And when we introduced our solution to integrate something, started to talk about the next steps, they said the earliest we're going to look at this 6 months from now. We small startup, like you said, ready to pivot any moment. For giants, it's much longer process for them to even put it on the schedule somewhere.
That's right. Yeah. It can be something that others accept because they can deal with longer time horizons. And I think there's some of us who just kind of need a little bit more of, if I do something today, I want to know that tomorrow or next week, I can actually start to see some results, even if they're bad.
Yeah. Let me create like a pretext of where I want to take our conversation. And I think our listeners will benefit a lot. My career ultimately got to a point where I also wore multiple hats, and I believe I'm ready to go to the next level. I want to build a big company, but I don't want to do a startup. I'm not a founder. I'm not a creator. I want to take something that already exists and take it to the next level because that's what I'm good at, right? And I went into a market, started to talk to brokers, signed NDAs, got the SIMs, the information about the business. And I started to see kind of, they all do not really follow similar format. And some include financials, some don't. And you have to go get that information out. And pretty much, I looked at probably over 40 by now. Not even one gave me information where I want to say, okay, I think this is it, I'm going in. So you request all the financials and then you find out even more how not organized it is.
Yeah.
And again, mingling funds, not accurate data, numbers are not matching. They tell you one thing, when you look at it, it's completely different. And even after a letter of intent, going through due diligence, also things not the way it was positioned initially. And also, so I do see a need for something like ExitGuide. I wish every business owner would actually start the business with the end in mind, right? I'm not just going to go use this as a vehicle for my lifestyle, but I'm going to go and prepare it. So, because it's not like a real estate where a house has a bunch of bedrooms, kitchen, bathroom, paint the walls, clear everything up, make an impressive kitchen, and you're ready to go. Business is much more complex, right? So coming into the business, okay, am I selling it to somebody who's in my family member? Am I going to give it to one of my employees? Am I going to give it to a strategic buyer? Am I going to sell it to one of my competitors? So when you have this from the beginning, while you're constructing and presenting everything and positioning everything the way it should be, the life would be completely different, right? So you saw that need as well. Of course, you started much earlier. So in your opinion, so not why, I guess the foundation, what makes the foundation wrong when we start the business that does not get people to think of exit?
I think what a lot of people do who go into small businesses, they have a passion around a particular craft or service or whatever it may be. Entrepreneurship is not something you do on a whim, rarely. I'm sure there's somebody out there who has, but it takes a lot of work to get a business started, much less to get it, successful in generating revenue and employing people and profitable. So it tends to be all consuming when you look at that balance versus your life. And when you're in it, you're not thinking about leaving it. And so you run a business to generate revenue, satisfy your customers, investors, if you have them, keep your employees happy, be a part of the community. I mean, the list goes on. So it's understandable that you can delay the thought process around exiting a small business. And I would, like you, love for everyone to think about the end in mind. That tends to be more of the mindset for, say, like a Silicon Valley company that raises venture capital, is everybody's thinking about the liquidity event, even when you're this scrappy team of 2 or 3 people trying to make something work. But the big part of why we do what we do is based on our own experience and data, as well as data available in the market. Is what ends up happening is when people don't think about it, they're not prepared, and they're not prepared, and then they try to kind of do this, especially if they try to do it on their own. Vast majority, over 80%, fail to exit. And so there's a huge need to actually educate people that says, look, this is in your best interest to think ahead. And so it's like retirement planning. You don't want to walk into the financial advisor's office when you're 62 years old and say, I'd like to retire in 2 to 3 years. What do I do? You want to start thinking about way earlier. So some of this is just educating people that they can do some things, months, quarters, or maybe even years in advance.
Would you say at least 3 years in advance? Because that's what we're asking from the sellers. We want to see at least 3 years of their financials.
I think this is oftentimes like advice you might get for lifestyle. There's what's ideal, and then there's what's practical. So what's ideal is everybody would exercise, 4 days a week. We would meditate daily. We would eat a largely plant-based diet and all these things, and, do saunas and all that. And yes, so 3 years in advance would be great. I'm also a pragmatist. We've had thousands of people go through our platform. I've talked to hundreds of small business owners who, are either trying to or plan to or have failed in selling their business. And so what I would say is, look, if you're thinking about this, 90 days is way too little. So we see a lot of people who come in and tell us that I want to sell this in the next, 60 to 90 days. If you have a buyer who's ready and lined up, then maybe, but I would say at a minimum 6 months, preferably a year, and ideally 3 years.
Yeah. Can we start with the type of exits that you see commonly happening?
Sure. Yeah. One of the things that I guess it surprised me, I've been doing this for close to 3 years now, is about 45% of people who are coming through our platform and planning to sell their business already know who that buyer is. So it's going to be an employee, a member of the family, possibly someone in their community, a business partner. They're not out trying to find that buyer. It takes the whole marketing of the business to potential buyers out of the equation, which also, quite frankly, reduces the pool of businesses that are available. Close to half are never going to come to market because they already know who's going to buy it. That, exiting can mean different things to different people. Some may mean it's not maximizing for price. It may be just getting it in the hands of an employee or a member of the family to continue the legacy. So it's an exit, but it may not necessarily be what everybody views as a big windfall. The other is sometimes it involves asset purchase. So this could be a packaging things up for one particular buyer or piecemealing them off. And you still have to kind of deal with the entity, whether that's an LLC or something like that. But selling the assets is another exit approach. And in some cases, winding down the business in closing, still an exit. And then there is what most people refer to as just finding a buyer and selling it to them.
Before we go into that one, asset, would you say that whenever there's an asset exit, usually it means I basically cannot find a buyer to do a stock purchase, stock sale?
To some degree.
Yeah.
And what do you do to failure? Life happens. And some are, somebody couldn't find a buyer. But in other cases, there's, life issues, health issues where someone does need to exit quickly and they just simply don't have time to prepare for the process, go through it. Fatigue is another, our businesses, small businesses are very intertwined with people's personal lives. And so sometimes it's the business that's driving the lifestyle, and sometimes it's life issues that are driving the business decisions. So with an asset purchase, it may be you can't find a buyer, but it also may be, hey, look, I'm going to sell off the assets. I'm going to pay down my liabilities and still have a chunk of cash that I actually can take out. And that may be more than enough for the individual from a financial standpoint, or it may be, hey, look, I just simply have to do this because a medical diagnosis or a family issue is just forcing me to, skip a process that might maximize a return, but I just simply need to get out and kind of address more important issues.
So it's a quick exit strategy.
Generally,
whatever the reason is.
Could be, yeah.
Okay, interesting. Yeah, that makes sense. Okay. And then we have a stock sale, right? So that's the second type.
Stock sale is when somebody is buying in. We don't see it. I mean, I hear people talk about it. Generally speaking, we deal with businesses that are worth less than $5 million. And that's about 90% of businesses in North America. So if you have a business that's worth, say, $5-10 million or more, you're going to find resources to help you. And these can be by, investment bankers, M&A advisors, business brokers. ExitGuide.com is much geared towards the individual, business owner who may have a handful of employees in a business worth, say, several $100,000, maybe $1 or $2 million. And so generally speaking, in our transaction, someone's buying all of it. We really don't see much where someone's saying, look, I want to sell 70% or 80%. I think sometimes people have a fanciful idea that they can do that, but in most cases, people are buying all of it. Yeah, but buying all of it means that the buyer is indeed taking, ownership and responsibility for both the assets and the liabilities for the company, as opposed to just acquiring the assets.
Okay, so complete takeover.
Complete takeover.
Makes sense. Okay, and when they come to you and when they go through that assessment, right? You're giving them assessment to see where they're holding. You're giving them a dashboard, scoring each. What are you scoring? Department?
Sure.
Overall.
So what we have what's called a sale readiness score. It looks and feels like your credit score. So if you're getting to go ready to go buy a house or a car and you're going to take out a loan, you open up an app like Experian or others and you answer some questions and it say your credit score is whatever. 725, for example. We basically ask about 20 some odd questions, and they're very similar to if you were to sit down with a M&A advisor or a business broker. They would probably do this over a cup of coffee or in 1 or 2 meetings, and they would say, tell me about your business. Do you have this? Do you have financials? Do you mix personal and professional expenses? They would go through that. We're doing that through an online survey. It takes 3 or 4 minutes for the owner to complete. From there, we generate a score. And it gives the owner a baseline sense of, okay, am I ready to sell my business? Or if I were to take it to market today, am I less likely to succeed because they just don't have the software? And so that score is really just kind of a baseline that says, okay, I like to call it a reality check. It's not a perfect science. It's not an algorithm. I mean, it's an algorithm, but it gives an owner a sense of where they are from the preparedness standpoint as a standard buyer who doesn't necessarily know them would objectively look at their business and say, yes, I'm ready to engage, or no, you don't have your act together just yet.
Are you like scoring based, again, just my curiosity, is it evenly, let's say we have 50 items that we look at and you're missing 20 of them because you're missing 20, this is the score. Is it even rating for each of the items, or certain items produce bigger value and therefore the score tremendously lower?
So some are, it's a good question. Some are weighted slightly more than others, but what we're trying to do is we continue to refine that. But what we're doing is, again, we're looking at kind of standard stuff that for people like yourself and me, we would say, okay, I'm going to ask, this owner, okay, Lisa, I'm going to ask you 5 questions, and then I'm going to say whether you want to continue on with the conversation. It's a little more expansive than that. But it's the stuff that a professional would look at and say, okay, if you don't have these things, it's going to be really hard. If you do have these things, then you're probably in a much better position to succeed. Let's get you some tools and resources to kind of package this thing up.
What are the top 3-5 things that you see people they don't have it or failed at producing it at the time when they take the assessment?
Sure. One is unrealistic pricing expectations. That does not mean that people think their business is worth more than it is. It just means someone has no idea. And so it's all over the map. When you ask somebody, what do they think their business is worth, they kind of shrug their shoulders and they say, I have no idea. And so pricing a business is not based on what you need for retirement. It's not based on what you think it's worth because you read something on Facebook. There's different approaches. We have a valuation report we sell for a couple $100, and that uses a market-based, methodology. And that sets a relatively objective price point for what the business is worth. So pricing it is coming to the top of the list. Two is related to this. It's financials. People aren't buying a story and an opportunity. People are buying a business. They may be attracted initially to a great story around a store or a service-based business that it's got a great reputation locally. It's been a cornerstone of the community and all these other things. But when they start to take a look, they want to look at P&L statements and balance sheet. If those aren't ready, or if those have some errors or are not up to date, you're going to kill the deal. So 50% of transactions fall apart during the due diligence process, starting with the financials. So pricing and then preparedness for due diligence, namely financials. The third is not really having a sense of like when and how you want to exit. And so if you want to engage prospective buyers, whether that's you're going to go find them, whether that's an employee or a business partner, it's really hard for the other person to stay in there and move through this process if they feel like you're not fully committed to it. I've never heard of somebody saying, if I get this certain number, then I'm willing to walk away. Maybe it's happened. I'm sure that somebody who's listening to this has heard about that happening, but really it's that kind of, I know I want to exit. It's going to happen in the next 12 to 18 months. I'm expecting to get between this number and that number for my business. That is a much better thing to deal with than somebody who says, I don't know, if somebody comes along now or in 3 years and wants to buy it, as long as they meet this kind of list of criteria, you're going to push a lot of prospective buyers away because they're not going to want to deal with it. They're going to go on and look at other businesses. So price your business well, be prepared for due diligence before you actually start it. And then 3, actually have some sense of when, why, and how you want to exit and stay committed to it.
Yeah, on the third point, I see that also a common thread where the sellers, again, I was focusing on businesses that where business owners want to retire, right? You mentioned baby boomers exiting. So you want to retire, are you willing to stay a month or two to exit, but is it really realistic, right? And so there's so many complications come with that. Some businesses, you can just take over, but if you've been in business for 20 years, there's no way in the world somebody who's not so experienced would come in and get that expertise, right? So the whole transition, in my understanding, is it looks much more attractive when the business owner says, hey, I know you're going to come in. I'm going to be realistic. I'm willing to stay a year, 6 months to a year for you to transition or bring somebody close to my expertise to assist you with running the business. That would be much more attractive than I'm willing to stay for a few weeks for you to take over, and then I don't want to do anything with it, right?
You make a great point. It's one of the questions we ask in our sale readiness. So when you get your sale readiness score, one of the questions we'll ask is, are you willing and ready to be a part of a transition?
Yeah.
The answer needs to be yes. Now, depending on the business and how long it takes, that it could be a couple of weeks, it could be a couple of months, and it might be bigger commitment up front and then start to titrate down. But you got to have some form of a commitment, absolutely, to making a successful transition, even if it's just transitioning relationships.
Yeah. Again, unless the operator was so good that they removed themselves, right? They removed themselves, but most of the time it's not the case. It's they made the personal brand within the business, all these sales relationships. It's their image, their face. People do business because of them, not because of everything else there. So for the new owner to come in to take over, they're not necessarily going to have the same bond and rapport. Yeah, interesting. Yeah. Okay. Anything else comes to mind? What would be the next?
Those are the big 3. I mean, if you know what the business is worth and you have the information ready for due diligence and you're committed to a path, it at least puts you in a position. There's no absolutes in this. I mean, we can't guarantee anybody's going to sell their business. I think that's a little bit foolish to make that kind of statement. Our job is to say, if your chances, coming in the door at a macro level are somewhere between 15 and 20%, we want you as that individual owner to increase the odds of you completing it through things within your control. We can't control the economy. We can't control interest rates. What we can't control is whether you kind of have at least some of these, items in order and that you're ready and you're prepared and you can move through as smoothly as possible.
Can we dive into those three? So one is you said the price, unrealistic price, right? And I see that too as well. For example, business, you look at the final numbers to take home, let's say 100K, and they want $1.5 million for their business as a sale price. So they basically saying that it's going to take you, investor, 15 years to break even if everything stays the same, right? So that's not realistic.
Yeah.
So how one goes and get to more realistic without actually going, what I also was curious about, you said that you have ability to go and see what the marketplace actually shares about those. So in real estate, we can go and look at the previous sales. Is there a resource, or is there a way for a business owner to go and get aligned about the price that they would be asking?
There isn't. The multiple listing system or Zillow has their Zestimate, which started and still uses MLS data. So there isn't a universal consumer-facing way of doing that. And part of that is because you've got to understand some of the things that may come in when somebody who's giving you that information, there's got to be kind of fact checking, so to speak, of what the numbers are from the potential seller. We used a market-based approach. We leveraged third-party databases that have, recorded transaction data, and then you have to kind of normalize it. There's equations that are going in on that. When you purchase a valuation report from us, what you're getting is kind of an analysis that uses third-party comps, and then you'll take out things like the highest and the lowest. You got to kind of look at it and be like, okay, that was, not sure what happened there, but that went for, say, 6 times revenue, whereas everybody else went for 2.4. So we're not going to use that one. We're running the comps. But, what we tell every seller is the first question someone's going to ask if you give them a price is, how did you come up with it? And if your answer is anything other than, I used a particular methodology, I use seller's discretionary earnings, I use market-based, I use discounted cash flow, whatever it may be, you've now entered this kind of crazy process of, well, wait a minute, what makes you the expert to say it's worth that other than just your personal opinion? And the best way to remedy this and get in front of it is to have an objective third party, generate some type of number for you using some form of widely accepted methodology. And then you can say, look, how'd you come up with that number? What we try to give sellers is, here's a market-based valuation report. It's 20 some odd pages. Read to your heart's content. And if you have questions or objectives around some of the assumptions, that's great. I'd rather a seller discuss assumptions and objectives around, multiples applied to an NAICS code than, wait a minute, this sounds to me like you just made this stuff up.
Interesting. Okay, so that reporting, but it also goes just like with the real estate, right? It goes to, you can narrow to a specific location.
Yeah, you can. It depends. So what we do is we're using, what's called an NAICS code, and that's the industry code. You'll do your best to look at, and when you normalize the data within a geography or within other factors, it just depends on what's available. As we continue to build up our data set, we'll become much more proficient at it and be able to rely on our own data. But for now, you kind of have to rely on what's available that's out there. So you may be pulling similar businesses that might be hundreds or even 1,000 miles away, but it's the best, versus trying to use businesses in the local area, which might be in completely different industries with different profit margins and revenue lines.
Yeah. So like Rob was coming from the angle that, the cost of living in New York, 1,000 miles away from Florida, is different than where I am located, right? And also, but at the same time, the population density is much higher there. So looking at the same business with the same number of employees, you might see different type of volume because of the population density, right? So things adjust. Okay, interesting. Okay, all right. So there is a logic to the madness of getting the expectation in place
For the
in terms
price.
of
Yeah.
price. Yeah. So financials, do you just tell them that, hey, looks like on the financials, you in red. We need you to clean up this, clean up that. Do you offer beyond anything beyond that, or you just giving them a score that you missing that, go figure it out yourself?
The score is more, but also includes some other information. So what we do for free is we just kind of ask a bunch of questions. And that would include, do you keep, your financials yourself, or do you use a professional bookkeeper or a CPA? So there's 2 or 3 questions that allow us to assess, what are the odds that these financials are actually accurate and up to date? Now, we don't know until we see them, but you can ask questions. And if someone says, I've been, doing this on pen and paper for the past 8 years, and I do them myself, and I'm a florist. Well, you might be actually financially adept, but odds are you're probably not going to have the financials up to date. So your score is going to go lower than if you said, I do $2 million a year. I've got a, bookkeeper on staff, and we use a CPA and have never been audited. Well, that's a different set of circumstances. So your score is going to go up based on how you answer those questions. But, when it comes to really kind of making sure that somebody has their financials in order, we want to know that they're accurate and they're up to date and have been so for a couple of years. And, we start with a valuation report. That's something someone can buy as a one-off. We provide also something called a guided exit. And that's where you can work with somebody to actually make sure things are in order. Now, if your books are a mess, we're going to refer you to a, bookkeeping or accounting firm. That's not something we do, but it's tied to what, we do. So part of our subscription package will include things that we will deliver, but then we can also say, this is a unique one-off thing that requires a proposal and someone to dig in and see how many hours it's going to take to clean up your books. And we have preferred partnerships of people that can do that for more complex transactions or things that require more.
Okay. So you will guide a business owner to get to the right resource who can assist them.
Absolutely.
Perfect.
Yeah.
Awesome. And the third, knowing when to exit, how the whole and so on. Do you assist the business owners with removing themselves as much as possible? Probably also as a paid service, you probably will refer them to some coaching or mentorship where they can focus on. Okay. So what that looks like.
Yeah, I mean, what we'll do is there's a couple different parts to this, but one is just having a realistic timeline that you can communicate to a prospective buyer. If somebody's not looking to buy your business, they don't want to have a wishy-washy answer of, I might sell in 6 months or maybe 2 years. If you're not committed to a timeline and, an exit path, you're kind of wasting everyone's time. And so that's going to really push prospective buyers away if they feel like, look, I don't know if this guy's committed to doing this now or 6 months from now or 2 years from now. I'm going to move on to other things. And even if you call back and say, like, you've already signaled that you're just not committed to this process. So the first is commit to the process and commit to a time frame. Now, if you can't sell your business in a year, that's okay. But that's a commitment that you're signaling to buyers, which is if you say yes, and you start to allocate time and energy and hours of your time to really do due diligence on my business, I'm not going to go away because I just decided, I wanted to stay in this or something changed in my life. I'm committed to this process. The other is what you're referring to is owner dependency. And that looks a little bit different, but the question that you ask yourself is, are you spending more than 30 hours a week in your business? And from there, that pushes into your score, which says, okay, the business may or may not be, but it's likely the business is relying on your involvement. Until we talk to you, we don't know if that's, maybe you're just enjoying it and somebody could easily replace you at a lower rate or whatever it may be. But if there's an owner dependency there, it looks more like the potential buyer is buying a job than they are a business. And that may be okay for some. But if you're too owner dependent and you need a pathway, then we do have a relationship with, a consultant who kind of will work with you through a program to remove that owner dependency. Somebody is buying a business as opposed to buying a job.
And that consultant is somebody who represents you, or just like with bookkeeping, you outsource?
Just refer them out.
refer them out.
Yeah. And these are all people that we have fully vetted and looked at their business and how they work with clients to ensure that these are people of integrity that know what they're doing and actually deliver real value. These aren't somebody is bidding on a, project from us and we're just simply taking it. These are just like, what we'll refer that business out. It's not core to what we do. Somebody who does it better, and they'll take that aspect of the relationship.
Yeah, because also when you look at the business, that it's not really business, it's a job. You tremendously, as a business owner, diminish the pool of potential investors who would come in and take that. I actually had one of the deals I was looking at, the numbers, everything looks amazing. I was excited to dive in. The challenge is the license. It requires for business. It was a plumbing business. I'm not a plumber. I'm not going to go do plumbing work, right?
Sure.
I'm more positioned on the business side. So that becomes an issue because now I depend on that license, and the business owner wants to exit, but how that license will be transferred. So if your business is, I know that they can leverage somebody else's, but again, they're putting themselves on the line. Some people lease it, but investors or SBA loans, they're not going to be relying on somebody else's license. You buying the business, we want you to be experienced. So in case a relationship doesn't work out, you have the license and you can take over. So basically, I'm trying to say that when a business, even you could automate everything, but if there's a license, you need to be even mindful of that if somebody comes in and they must have that certification or license, you basically, again, diminishing the pool of potential investors, and maximum sale price, I guess, also gets to diminish.
No, I agree with you 100%. And especially in businesses, plumbing, HVAC, a lot of home services that require some type of professional licensing. That said, the same is true if you talk to SBA lenders. Even if it's let's just take a floral shop. You kind of think, okay, I don't need a license to run a floral shop. If you work in tech or in manufacturing and you decide you want to buy a floral shop, if you've never done this before and somebody who may come in and make a little bit lower offer, but they have 5, 10, 15 years of experience in the floral business, the lender in a bank or private investor get way more confidence that the business will succeed and they're going to get payback on their loan with somebody with experience. So that's an instance that absolutely does happen, where someone will say, I'd rather take 10% less for the business and put it in the hands of somebody who's going to succeed and grow the business and pay this loan back with interest, versus somebody who's willing to pay a little bit more. They don't really know what they're doing because they don't have any experience. There's a risk there that they might actually fail. I'll never get my loan back, and I'll end up having to foreclose on the loan.
Yeah. In your experience so far, any story that comes to mind, like exit that was a wow, that somebody came to your system, did the assessment, they were at this point, and next thing you know, they cleaned up, prepared, and that's what they end up with versus what could have been if they did not?
It's hard to say what number they would have gotten had they not worked with us. I think for us, and for me in particular, having been, involved in starting this business, we've had several, a spa and wellness center out of New York, a, lymphatic massage clinic in Florida. We've had consumer products and manufacturing businesses. What really is a joy, this is going to sound a little bit corny, but I do mean this. What's really a joy is having somebody come in the door who really is stressed because they don't know what they're doing. And so what I often tell people is, we've built tools and a dashboard and resources that help people kind of do the things they need to do to get ready and complete the transaction. What we're actually selling is confidence and information and knowledge. And so for me, the big joy is when somebody comes in the door and then we see, 6 months later, they may come back to us, or we're working with them relatively closely, and they say, I actually got it done. One of the ones I just mentioned in New York is this woman, Linda, is just, she wanted to sell to her employee, and she was all over the map. She was super stressed about it. And just the excitement that comes back when she got it done, because you're enabling people to do something that they thought they might not necessarily achieve. And that's awesome. That is at the heart of what we do, is when somebody says, I got it done. I didn't think this was going to happen. It's almost like you help someone train for a marathon versus they just woke up on a Saturday and be like, I'll go downtown and strap on a number in my shoes and go make it happen. You're like, okay, very few people will actually finish this thing without dying. But if they work with us, we're kind of training them for that marathon. And sure, they may cross the finish line 6 hours later, but they got it done and they didn't think they could do it. And that's magic.
Yeah, that's pretty cool. I mean, in an ideal world, it would be perfect to request information about the business and you getting this package. Of course, after you sign the NDA, you getting clean financials. You see the business works with or without the operator, but these are the things that you need to have in place as a buyer in order for you to operate. So basically, everything is transparent.
Yes.
So you can just make a logical decision to proceed forward or not and not struggle. Yeah, I see a huge need for what you're doing. It's amazing that you saw it and actually put together a tool that
Yes.
assists.
And we do. So when somebody moves through our dashboard, what they're doing is they're actually doing everything from they have to do some writing, because you have to kind of provide a narrative around your financials. You can't just send someone P&L statements. I mean, you can, but you want to explain and add commentary to it. There needs to be a history of the business. Why did it start? What makes this thing special? There's explaining the deal opportunity. So all this stuff gets pulled together in the dashboard, but then it translates into, really two things. One is a sale page. So when you're ready and you say, hey, look, I want to start telling people that my business is for sale. Because what we say, telling them your business is for sale before you're ready could be one of the biggest or the biggest mistake you'll ever make. The other is when you've increased your sale readiness score and you're ready to kind of share that, you have a page that you can put out there. And people ask, I get this question a lot, what do we think about online marketplace? And if through your subscription plan, you're working with us, we may say, we think it's a good idea and here's why. We may say, we think it's a bad idea, here's why. Ultimately, it's up for that owner to decide. But what I can tell you is online marketplaces don't serve you well if your business is hyper-local. So if it requires that all of your suppliers and customers are, in a local community, somebody living in Austin, Texas, looking at a business in Miami, Florida, unless they plan on moving there, quite frankly, it's a waste of your dollars and time. And then when you're ready to move into due diligence, all the financial information and other things that you've done go into what's known as the buyer portal. And so you share that with somebody who's already signed an NDA. So the sale page attracts people, but it's that narrative and that special story and some of the top level financials that you kind of entered into your dashboard that turns into a sale page that you can share on social media. You can share it, by email list. Hopefully people start to pass it around. It gets that attention focused on your business, invites that conversation in, and the work that you've done by uploading P&L statements and balance sheets and formation documents and all this other stuff. Why am I doing this? You then click a button. It says, okay, share it with these two prospective buyers. Then you can control who's going in, what they see, and they're able to get the information that they need. Now you're moving through due diligence with the confidence of, I have all the information there that, any professional buyer would want to see.
Eric, just to make sure I understood correctly, all this is offered by ExitGuide.
Yeah,
The sale,
absolutely.
besides getting a dashboard and the score and all the resources to assist to get that score as high as possible, also you generate a sale page, which
Correct.
they can share as a link. When
Yep.
somebody shows interest, they'll sign the NDA and they'll gain access to financials of the business. And
Yes.
because everything is so transparent and formatted in exactly the way the buyer would expect, it's easy for them to make a decision. And do you get involved with the due diligence or anything like that? Because, individual quality of earnings come into play, the things on the legal side with do you get involved in any of that or your
Well,
service?
the answer is it depends. If it's, for example, just legal templates, you want to get an asset purchase agreement or a business purchase agreement, we provide those. If you want an attorney to actually take a closer look or ask specific questions, that is something that we're likely to refer out. So where it gets very specific and customized, we absolutely can make referrals. If it's something that is a question around, should I be generating this type of a cash flow statement versus a income statement versus whatever, maybe if there's tactical questions about the process, that's included in your subscription plan. If it's something that requires professional advice, such as a CPA or an attorney, we are going to refer that out to one of our partners.
Yeah, and they're probably already working with someone because by the time they got to the place where they've been sharing their private info, everything is already cleaned up and they're probably
It,
working with someone
it,
closely already.
yeah, it is. It's a good point that you bring up. I'm a little surprised at that because, and I think this is a healthy thing. What we find is sometimes attorneys that work with a lot of small businesses or CPAs that work with a lot of small businesses, most of them will say, I don't have experience in mergers and acquisition, or I don't have experience in performing valuations. Now, like as an entrepreneur, you might be able to relate to this. And this is a good approach. We tend to think, I'll just go figure that out. I think people who are professionals, it's kind of like a doctor or an attorney. If you go to them and you say, look, I've got this thing on my skin, you're seeing an internal medicine specialist. They're going to say, go see a dermatologist. Like I kind of know what that means. So what you find is in some cases, they may want to, have their current attorney working with them. In other cases, they'll say either their choice or the attorney has said, you really do need somebody who specializes in this. And so that's why we've kind of tried to provide that flexibility. We really want to give you that dashboard so that the owner can kind of go through and, self-directed. Okay, now I need to know what to do next. It's chasing information down. It's uploading files. It's writing things out that really only the owner or the seller can do. The professionals can vary whether it's something that we can answer by email and provide kind of, very technical support. But we don't want to leave anyone hanging if they say, look, this is very complex. I really do need to talk to someone. We don't want to leave them where it's, look, you're on your own. This may be outside of the scope of ExitGuide. And we'll say, look, here are people that we've vetted. They can help you with this. And that's an engagement you need to take on between you and them.
Yeah. So it all depends on the complexity of the purchase agreement, what the exit actually look like. You completely exiting, you partially exiting. Is there the earnouts and a bunch of other things that get into play? So you basically have a pool of businesses and you kind of positioning everybody to potentially bypass the broker and save that money if they go through this whole process themselves.
I would say no. And here's why. I think there's what we've seen in technology over the past 30 years is there was a time, I'm not going to guess your age, but I'm going to signal mine. There was a time where if I wanted to fly from Dallas to Chicago, I would call up a human being to get my plane ticket, my hotel reservation, my rental car. We think of that now as just silly. Same thing. If I wanted to buy 100 shares of Apple stock, I would call somebody up to actually place that order and fulfill it. Taxes, I can only go through CPA. Now I can do that through TurboTax. For what I like to call is the low complexity, high volume transactions, ExitGuide is taking that on, much like LegalZoom did with business formation, and we can supplement the online service with experts. If you are going to take your family on a African safari, or you are looking to do something that is more complex when it comes to managing a larger investment portfolio, you may engage an expert. And so I view ExitGuide as if a business broker is really not doing his or her job and they're just simply posting this on BizBuySell and they're not doing much, you hear anecdotal stories that are out there about people who that's all they do and people get frustrated. Yeah, I guess we'll replace those. But the good ones, and there's a lot of them that are out there that are really skilled at helping position a business and bringing it to market to a very targeted audience of specific buyers, we're going to be more of a back-end tool. We're going to be the tool that they'll use to send to their buyers so they don't have to keep everything in email and Dropbox and doing all these other things. So we actually, work with brokers and exit planners who say, this is great because what it allows me to do is to save a bunch of time and build my pipeline with qualified interest, because people have to go spend a little bit of time doing some of the upfront work, but I can actually focus on providing the advice. So as it moves up market, our model changes from direct to consumer to actually working with and supporting the brokers and the exit advisors.
Nice. Very cool. Interesting. Awesome. Anything else you want to share before we call it a day today?
Look, if you have questions, you can certainly contact me. My name's Eric with the C, so it's eric@exitguide.com. I would encourage anybody to go to exitguide.com if they want to get their sale readiness score. And I would just leave everybody with kind of where you focus your time and energy, which is learn about this, plan ahead, and be prepared, and don't try to figure this out on your own. There are resources that are out there. But if you try to wait to the last minute, you really are doing yourself and your employees and your customers and your community a disservice. So get ahead of this. We're happy to help. There's other people like you out there that can actually help people. So take advantage of that, and you'll feel a lot more confident when you go into this process.
We'll place your email, the website, and maybe your LinkedIn as well.
That would be fantastic. Yeah.
And below this video to share. Before we disconnect, one last question. You mentioned the readiness score. Do users have to pay to see the score,
No,
or they
that's
will
free.
get the score for free? Awesome.
You go to
So
ExitGuide.com.
yeah, basically
and it's free.
nothing to lose. Just go spend a few minutes, answer the assessment questions, and see how ready you are to sell your business. I strongly believe it's needed. I would jump on this. I'll actually take a look at this myself as well.
Very good. I appreciate the opportunity, and thanks for, encouraging people to take advantage of this.
Yes. Thank you, Eric. We'll keep in touch.
Thank you.
Thank you. All the best.